We're going to wind up this chapter by discussing the dollar value retail method as well as the effects of inventory errors. So buckle up for this one. All right, so we talked about the retail LIFO method, but this was only applicable to the extent that there were no changes in when there is a change in retail price during the period, you can combine the retail LIFO method, which we had learned about previously, with the dollar value LIFO method to eliminate the effects of the price change. And thus we get the dollar value LIFO retail method. So what does this mean? And I'm going to go through the steps and then we'll look at examples. So we start out as we had done previously. We compute our ending inventory at retail we start with our beginning inventory, add in our purchases, deal with the markups, the markdowns, and then our ending inventory at retail is converted to base year retail prices by applying the base year conversion index. What is that? It means we're going to multiply our ending inventory at retail times a ratio of the base year retail price index divided by the current year retail price index, or current year price index. And then the change in inventory at retail and base year prices gets computed by comparing the inventory with the beginning inventory when they both, you can read it, both are measured at the retail and base year prices. And as I said, in a minute we'll go through a slide which does this in numbers and it will be easier. So the change in inventory at retail and base year prices is converted to the current year retail prices by multiplying it by the appropriate conversion index. If there is an increase, the current year conversion index is done this way, and I won't say it because I'll just confuse it. If there's a decrease, the current year conversion index is done for each of the LIFO layers. So increase, you got one calculation. Decrease, you've got to do it for each layer. And so the change in the inventory at the current year retail prices gets converted to the cost by multiplying it by the cost to retail ratio for the appropriate year. And then you can calculate your ending inventory at cost by either adding or subtracting to the beginning inventory. So what does that all mean? So here we've got the Weston Company, and we've got cost and retail figures for 2016, 17, and 18. We've got our sales, our markups, our markdowns, and we've got the price indexes. So then you see that step one gets us to our ending inventory figures for these 3 years at retail using the same methodology we've been doing all along, dealing with markups, markdowns. And so now we calculate what the ending inventory at retail at base year prices is. So we take our base year, let me go back. So you see our base year at the beginning of January of 2016 has an index of 100. And so we have a ratio of the base year to the current year, and we multiply the ending inventory by that. So for 2016, that gets us to 15,000. And just so this was the beginning of 2016, and this is the end of 2016. And then we've got the end of 2017, the end of 2018. So we're going to take these index figures for the beginning of our base year here and divide those by the ending inventory figures for the next years that we're looking at. And so we've got, for example, our ending inventory figure of 23,960 at 2017 is multiplied by the ratio of the base year inventory index, or price index, excuse me, versus the ending 2017 price index. And that gets us 20,835 for our ending inventory based on the base price indexes. And then we've done the same thing for 2018, and that gets us to 19,142. Then we look at the change between the inventory at retail versus the base price. So we've got our inventory at retail, and we look at the change from the base price, and that it's 3,000 here, and it is 5,835 here, and then we note that it actually goes down in 2018 from what it started with at retail. So now we come up with a ratio between the index for the current year and the index for the base price year, and we multiply that by the change. And I'll just go up so basically we've got our three change figures here. And so then you may be saying to yourself, but wait, the index for 2018 wasn't 115. Why are we using the 2017 index figure? And if you remember, which that's okay, you probably don't. When there's a decrease, as we saw with 2018, we do the base price of the most recent layer added as our numerator. And so the most recent layer added was the 2017 year. And so that's why we're relying on the index for 2017 for the year in which we had a decrease. So we calculate each of our change figures by the price index ratio that's relevant for that particular year, and we come up with these figures here. Then we multiply those figures here by the cost to retail ratio for purchases, and it just reminds us down here what those are. So we've got for the first year, and I'll scroll back in a second so that you can see those, but for 2016, so for 2016 we had purchases at cost of 20,400 and at retail of 32,000. For 2017 we had 25,600 and 41,000. And then because 2018 was a decrease, we then default backwards to the most recent layer added, which was 2017, which is why we're going to use this ratio twice. And then, so we will multiply these intermediate calculations by the cost to retail ratio for our purchases, and that we come up with three new figures here. And what these are our purchase layers for these various years. So now we look at our beginning inventory figure for our base year, which was 8,000. And I will scroll back up and remind you at cost. And we will add the layer related to the 2016 purchases to that. And then we move on to 2017 and we add to 2017. So we've got the 2016 beginning inventory at cost plus the beginning inventory purchase ratio figures. And then we add the 2017 figures. And so then we get to 2018, and we've got, again, 2016 beginning, then we add 2016 purchases, 2017 purchases, but then we subtract 2018 from that because it was a negative number, and that gets us to our ending inventory using the dollar value retail method. Woohoo! And I'm going to finish up here talking briefly about errors in inventory valuation. And so when we make a mistake in inventory valuation, because inventory shows up on our balance sheet, so obviously if we have a mistake in our valuation, it will misstate our balance sheet one way or the other, depending on whether we figured too much or too little inventory. But it also is calculated into the cost of goods sold, which then shows up on our income statement, which will similarly result in a misstatement on the income statement if our inventory figures are wrong. So what do we do if we discover that we've made a mistake in our inventory? And the answer to that is that it depends on when we figure out we made the mistake. So if we made the mistake in the current accounting period, then we just make a reversing entry and we correct it and it's all fine. If we don't discover, though, until after we've closed out the accounting period that we've made the mistake, we now have to do a correction in the new financial statement, and we do it as a prior period adjustment. So we'll look at some different scenarios about how these errors will show up on the various statements. So in our first example, we have a purchase on credit that gets omitted from both the purchases account and the ending inventory and is not recorded in the succeeding year. So in the current year, the errors in terms of the income statement, the errors are going to offset each other. But on the balance sheet, the ending inventory accounts will, and accounts payable will be understated. Then in the succeeding year, and this is if we don't catch the error, the income will be overstated because beginning inventory is understated and therefore cost of goods sold is understated. Well, you can read the rest. Now we have a purchase on credit that's omitted from the purchases account, but we did somehow manage to include it in ending inventory. Not quite sure how that happened, but we did. So now we have income that's overstated because the purchases are understated, and well, I'll let you read this. And now we have ending inventory is over or understated due to quantity and or costing errors, but the purchases are correct. And you can read through how this impacts current year statements as well as succeeding year. Now we've got Picasso Company's periodic inventory at December 31st overstated by 5,000, but the purchases are correct. And Picasso correctly values its 2017 ending year inventory. And so this shows beginning inventory correct, purchases correct, ending inventory is up by 5,000, so the cost of goods sold is down by 5,000. But now we get to beginning inventory, which is now going to be overstated by 5,000. Purchases will be correct, and the ending inventory is corrected, but the cost of goods sold will be overstated by 5,000. And we will very briefly touch on the application of lower of cost or market in a periodic system. So we had discussed perpetual before, but very briefly we will deal with periodic. And so perpetual is where we're basically tracking our inventory in real time. But in the periodic system, we will either use the direct allowance the direct method or the allowance method to write down our inventory to the lower of cost or market. And so conceptually we do it the same way, but the journal entries are going to be different. So for Tampa Company, we have inventory values, and so we're even for 2015, but in 2016 and 2017, we have the market value is lower, so we're going to write down our inventory. And so we start off, we've got our beginning inventory figures from 2016, which were our ending inventory figures from 2015, and they were the same. So we have the same entry under both methods. But now we get to the end of our ending inventory of 2016, and we've got a difference between our cost and our market. And so under the direct method, we're going to debit our inventory and credit our income summary at the market value, whereas the allowance, we're going to maintain the book value. Then, and we have no second entry required under the direct method, but under the allowance method, we have this separate line item that we need to record. And then in 2017, we again start with closing our beginning inventory figure, and we've got to make the adjustment for 2017 because our income summary account for 2017 was at the book value, and so we need to then enter a debit to the allowance to reduce inventory to market value, and then we credit our inventory. And then our ending inventory, wrong way. We've got a market value of 28 and a cost of 30. So again, we record the market value under the direct method, and we've got the two-step entry under the allowance method at the cost, and then a separate line item to record the loss. And that concludes Chapter 8.